Cantor Fitzgerald. Eric, great to have you on. We did see stocks pop here this Monday with the S&P up to 39.51, the Dow finishing the day up more than 1.2%. And we did see some of those underperformers from last week that are so economically sensitive, like energy, materials, industrials, leading the charge today. Your thoughts?
Yeah, so today was a little bit of a relief post the CS news over the weekend, but I would not get distracted by some of the nuances around around Credit Suisse or what's going to happen with FRC or Silicon Valley Bank out of receivership. I think the bottom line from the events over the last 2 weeks are twofold. Number one is that credit is going to tighten significantly coming out of this. So this was happening prior to Silicon Valley Bank. If you look at some of the surveys from loan officers, credit heading into it was one of the five tightest conditions in the last 30, 35 years. And each time we've gotten to this level, we've seen a recession very shortly after. And that was before the Silicon Valley Bank news. So no matter how this gets resolved, regional banks are a tremendous source of liquidity to this economy, and they are going to be tightening their credit standards. The second takeaway from what's happened over the last 2 weeks is that you can't go from the tightest policy, the most loose policy in the history of the Fed, and then turn that around 13 months later and have the tightest we've seen in the last 20, 30 years and not have an accident happen. And so this was a reminder that not that it'll necessarily be this playing out further, but there could be something else that is going to pop up. Because that's what has always happened when you have these type of reversals in Fed policy, and this one has been sharp.
So what you're saying here is that we haven't necessarily seen the full impact yet of all of this tightening of the past year. Is recession priced into the market here? It's
not. I mean, it's pretty incredible. I mean, when you look at, I think almost no chance is being priced in. And I say that based on the numbers, which is that right now the market is trading at 18 times the earnings estimates that we see in print, which if we were to have a recession, the numbers would be far lower than where they are in print. 18 times, let's look at that over the last 30, 35 years, it's only been higher during the COVID bubble and the internet bubble. So otherwise, this has been the peaks. We're trading at peak multiple on earnings that are too high. And in terms of the odds of recession they're very high, and the rate market, a lot of the dynamics that I can walk through, but a lot of the dynamics in the rate market are suggesting that it's coming much sooner than people thought 2 weeks ago.